All right. Well, good afternoon. Still morning for me.
Yeah, this is good, man. Michael, it's been a long time since I've seen you. You have way more gray since the last time I saw you. This is awesome. I love it.
It's this industry. That's what this industry does to us, right? It takes hair off the top of our head and it puts the hair onto our face and turns it gray, right?
It was all 2023. This is what it did to us.
Oh, I'd say it was a few years before that too. The great housing recession, earlier, the decade or a couple decades ago started the process for me. That's for sure.
Well, no, look, awesome to have you on Real Fridays.
Glad to be here.
Yeah. What we do every Friday, and I explain this for those who watch this later on and they try to understand sort of the format is, we have a pretty free flowing but content rich conversation about the industry, headlines, rumors, or things that we've heard, or just observations that we're making in the market. And so generally, Jeremy, being a lawyer and being kind of a housing expert, on residential and tech platforms, he has such a phenomenal sort of place to a role to play in this. And then of course, Brock, as sort of a real estate sort of tech innovator, he kind of marries the two between real estate and mortgage technology, right, having come from Rocket, and then applying that really rich experience that very few people get, and apply it to various tech innovation platforms. And he's doing just a bang up job at NewsZip. And then myself, I just sort of facilitate.
No, you do a lot more than that. I've been watching and commenting and engaging with you guys, and you do a lot more than that. So I appreciate the humility, but I'm glad to be here. This is great.
Yeah. No. So. Jeremy's not with us today. He will sound like he passed away, but no, God willing,
he'll be with us again one day. Yeah.
Jeremy will be with us next week, or he'll probably show up a little bit late. But with that said, I'm really happy to have you here, Michael, because we interacted. It was a number of years ago. I think you lived in Minnesota, and then you went to North Carolina, and then I think you moved your family back in Minnesota.
Yeah.
So, but I look at you as, and this could be a mischaracterization, but I look at you as really, you're a representation of really the wholesale channel. Would that be a fair? I think you worked with Fairway for a while, and there's that kind of wholesale retail, but you were really on the wholesale side at Fairway, right?
No, I was at a hybrid retail role at Fairway, but you're right. In terms of my broader career has been correspondent and then wholesale between the two. Retail, not a huge part of my background other than buying from IMBs, a lot of, over my career for 27 years, mostly a third-party lending background. So you're spot on with that. The Fairway gig was an experiment for a little while.
I mean, if you can talk about, what's your take in Fairway exiting wholesale? Good move, bad move? Do you think that was just necessary for the strength of the retail platform? Like what was your take on that?
Yeah, I think it's three things. One, it was never core to their mission. They've been in wholesale for, I think, 11 and a half, 12 years. But as an outsider looking in and then becoming an insider back in late 22, it felt like it was an alternative strategy. It felt good at the time, I'm sure, when they got into it. But it never really turned into, I think, what their hopes and dreams were of being a huge part of the company. They are probably at this point always will be really focused on traditional retail. And so the move with wholesale and with their direct-to-consumer channel and with the channel that I was running kind of felt like let's get holistically focused back on traditional retail and really focus on the branch network 100%. And that's really what it felt like. So, and I don't think Fairway Wholesale ever got to the size that they were hoping for. I think they're, from what I recall, and I was not in that channel, so I'm speaking a little bit from an outsider's perspective. I think the biggest year they ever had was around $3 billion in origination, which we all know in a wholesale channel, when you've got Rocket and UWM and Penny, that's kind of the big $3 billion a year. It just doesn't measure up, right? It's just too small a strategy compared to the overall origination volume of Fairway. $2.5–3 billion is kind of inconsequential, less than 10%. So it feels like they really got pure on their strategy of let's be all in on the branches, which that's a strategy.
What's the retail wholesale breakdown at Rocket? Do you know, Brock, or do you know, Michael, what that breakdown between the two is?
It's hard to tell. I follow their, the public financial statements. They do a really good job of melding things together, between State Farm and Primerica and, the traditional retail channel and some of their other, unique retail origination channels. I don't know the actual splits. If I had to guess, Rocket Pro TPO has been becoming a larger and larger part of the overall origination volume at Rocket, just given the fact that the broker community feels like they're able to access purchase business more effectively than a direct-to-consumer call center can, right? That's not a knock against Rocket. It's just the limitation sometimes of a consumer direct platform and purchase. So if I had to guess, it's probably north of 35% at this point.
Yeah. I mean, I haven't been at Rocket for what, 4 or 5 years. So I'm not really sure today. I think it was much less than that when I left, and it's grown probably every year since. So that sounds about right.
Yeah.
It's funny because I'm such a, I obviously, I grew up on the broker side of the fence in the early 2000s. And then, of course, when I managed sales, marketing, business development over at Calyx, 68% of the market used, Calyx's LOS. So I had a real finger on my pulse in like 06, 07, 08, and 09 of the sort of the broker community. And in most, 2/3 or so of originations were all coming from kind of the broker community. So it was, a good time to be in wholesale, right? Until the regulators decided otherwise. But, it's interesting to me, Dave Stevens, God rest his soul. Like he was the one I was talking to him about 2010, 2011. And I was really sort of, down on the broker community, right? Because I felt like that, the broker community had really sort of let the industry down through a lot of the challenges. Because sort of, it's kind of like if we don't regulate ourselves, someone will do it for us, and it'll be a lot worse than if we actually sort of impose some internal constraints on our worst impulses. And it was just kind of a phase I was going through, I think, in my career. And so I had some satisfaction to some degree of the broker community getting down to 8, 9, 10, 11% market share because I felt like sort of the wholesale market kind of deserved it. And I remember Dave Stevens, who was kind of, I don't think he was chairman of the MBA yet, but he was sort of on his way. And he was like, you know what, Rick, the market needs a really strong wholesale segment, like to have a healthy mortgage market. And here's this guy who's an independent mortgage bank guy. He's doing all his consulting. He's on his way to run the Independent Mortgage Bankers Association, right? And he's like, Rick, don't be so down on the wholesale community. It'll come back stronger. But you got to give it some time, but the America needs kind of the three-legged stool of origination, your depositories, your independent mortgage banks, and in a wholesale and the wholesale channel. And if that pendulum gets out of whack, as we've seen it in our careers, it's just not good for the consumer. And I thought that was a pretty insightful perspective.
I would say anything that seems to have ever come out of David's mouth always was, right? God rest his soul, and miss him and miss his leadership in the industry. I think he had a great perspective, and I don't blame you for the perspective you had. I'd take a further step back to that era and say that I don't think you can just solo out the broker originator as, potentially culpable in the origination of all the horrendous loan types that we did back in that era. I think it was any originator. I think that the broker community leveraged more of the, per capita, they probably originated more dollars within their walls than a lot of IMB loan officers did, just because it was a different asset class or a different loan type. But I think every originator kind of let their guard down, and thank God for the SAFE Act and a little bit more, parameters around who can get a license and the background that they have to get it. And I'd argue that wholesale actually got down to 3 or 4% market share post the housing crisis. 10 or 11 might have been 3 or 4 years ago, and it's climbed back to, I think the statistic I saw yesterday was it's climbed back to 25% share in 2023. So
yeah, I saw that from Ishbia's post.
Yeah. So I don't know if we take that as gospel or not, but it feels about right.
I actually thought it was closer to 28%, in some of the things that I've been reading. So I thought that he was quoting something kind of a lower metric, but if there's anybody who knows, it's going to be Matt's going to have his arms over the.
Yeah, it was a little lower than I thought too. When I went to the AIM conference last year, October, November, whenever it was, they were saying it was around 30%. So,
So here's a crazy thought for the two of you to ponder. I'd love your reactions to this. I wrote this down last night. I figured we might spend a minute talking about the wholesale channel. you have two things working in opposite directions. You have this growing percentage of wholesale mortgage broker market share, right? I'd argue it got down to 5%, we'll say, at the low point, coming down from the 60 percentile range pre-housing crisis, right? So take it 60, the door slams, the great housing recession happens, drops, precipitously, not just like a step down, but like a fall off of a cliff down to 5%, and starts building back slowly. Now it's up to, we'll say, 25% for round number purposes. At the same time, while that's exploding and you've got loan officers leaving IMB land and depository land and heading to the broker channel, you have far, far, far less wholesale lenders in this space. So it's like two graphs working against each other. You've got the number of wholesale lenders to support this growth going down dramatically. You've got the number of LOs entering the space growing dramatically. And so here's just a list of names in the last 18 months that I wrote down of wholesale lenders that have left the marketplace. Some names that we'll look at as kind of household names, and others maybe played a specific kind of specialty role, but Stearns, my firm, Amerisave Wholesale, Finance of America, Fairway, Crescent Mortgage, who served the small community bank credit union marketplace very well for decades, Home Point, Annie Mac, Impact, Loan Depot, First Guarantee, and US Bank. That's a long list of pretty big names that have left the wholesale space in the last 18 to 24 months. So, if you're a broker now and you're making this choice to enter the space, good for you. You're obviously seeing a lot of benefits, and there are benefits to all three channels, right? All three legs of the stool. But now I'd caution people to kind of keep their eyes open, and history has borne the story out. No one wholesaler or two wholesalers or three wholesalers has ever controlled the amount of market share that they control right now. The three-horse race, it's kind of UWM, Rocket Pro TPO, and PennyMac, and then name somebody of major capitalization or differentiated tech in the wholesale lender space. Who's the fourth? Who's the fifth?
Now,
who's the sixth?
It's kind of interesting because it is pretty splintered after that, and I wonder. On one hand, I was thinking that it was so overly leveraged toward UWM that perhaps that wasn't healthy for the market. And you hear a lot of the criticisms around, essentially UWM is benefiting from essentially 1099 contractors who otherwise really should be employees, because most of their business really gets fed into UWM. But so I wondered if it was an antitrust or some kind of an FTC issue, just having so much consolidated production around one particular lender, or is it just a function of that one particular lender just happens to outcompete everyone else? And there are a lot of, like, AFN as Orion, they have there's the lender out in Southern California that does a couple billion a year. So there are a lot of names.
There's a lot of names, and they do good things in the market. I'm not trying to take away from anybody not named UWM, Rocket, or PennyMac, but if you look back over history, share was spread more evenly amongst the top 7 to 10 players than it is now. And I don't know what that means. I don't know if I was a broker loan officer or broker owner right now, how I'd feel about my limited choices, right? Because if you look at the list of other names not named those first three I've been talking about, the capitalization level of those companies it's a vastly different story than the first three. And I agree, the first two are a vastly different story than the third even. But Penny being the manner in which they're capitalized with the restructure and all that, very profitable, very well capitalized as well. I don't know. I'm not saying something's better than the other necessarily. I'm not saying that having a big three is worse than having a big 10. But I think if the broker's superpower is choice, and I believe that it is, that is their superpower for the consumer, it's the power of choice and the ability to shop for the consumer. Having three bigs, I don't know if that's necessarily the right answer. And time will tell, how that plays out. I'm a history buff, and I know you are too, Rick. And so I look back over time and I say, look at the big names of wholesale from 30 years ago, TBW, Tabina Whitaker, 20 years ago, InterFirst, 15 years ago, Countrywide. None of these names are, even alive anymore, not even alive, right? I hope 10 years from now, we're not repeating the same story and naming companies that no longer exist that are the big three, because that's going to be really bad for the broker community and all this growth that's going on right now.
So how far, what do you think, is there a ceiling, do you think, to the broker growth in their market share? What's your take on it, just from having, dabbled, or at least, having your one foot in retail and in an entire leg in wholesale?
Yeah.
Like, what would you say to be
I think there's
Your
everything's a pendulum, right? Everything we've ever seen over our careers together has been a pendulum, whether it's rates and volume. And I think share is another one of those things that operates on a pendulum. And I'd argue that the three names, especially the first two that I've talked about, have done such an incredible technological process flow oriented job in gathering the broker's attention. UWM, I think of them as a mortgage company second and a technology company first. If you've ever experienced their technology directly or indirectly, it's an ecosystem. I mean, the broker comes into the ecosystem and doesn't have to leave. Same thing with Rocket Pro TPO. They've done a brilliant job of creating everything that a broker would need, including leads and opportunities and CRM and LOS and POS and PPE. Everything is in those two, and even Penny's ecosystem. So the broker never has to leave. And I feel like those investments have been made for the previous 10 years in a row, culminating in a really attractive package of goods for a loan officer to say, what channel do I want to be in? At the same time that those three, and particularly the first two, have made these incredible investments and advancements, I look at the rest of the mortgage market as just now finally catching up. I'd argue the average IMB in retail is just now starting to make big investments over the last couple of years in technology and in process flow. And so I think the pendulum has swung towards a more innovative way of originating and a better ecosystem, or an advantageous ecosystem in wholesale. And I know there's a lot of IMBs that I talked to or that I was at that are making investments in tech and process that will probably help swing that pendulum back, and things will level out. So I think the broker community is probably still has a little room left in it, 32, 33%. And if you look back over history, that's probably a healthy place for it to be. I liked your three-legged stool concept. A great industry would probably be a third, right? A third wholesale, a third depository, and a third IMB. Now, we know there's challenges in the depository world right now. For us to think that a third is going to be depository is probably a little bit foolish as well, right? Because it's not even close to that.
Yeah. It's funny. There is a market research kind of rule of thumb in any market, whether you're talking about disk drive manufacturers, whether you're talking about candy bar manufacturers, bicycle manufacturers. There is this thing called the rule of three. And for any healthy market, developed market, there has to be three major pillar players in the space. And then generally there's a number of the smaller fish that ride under the whales, right? And it might very well be sufficient to have three major players like UWM, Rocket, and Penny. And it's not as though any one of those three are lacking in capital, market share. I mean, they're holding their own. In other words, none of those three are sliding. Like you see a pretty active pendulum on the retail side of lenders either percolating to the top or lenders that sort of fall back because of either channel issues. They might be overly leveraged on consumer direct, and so it helps them some years and it hurts them on others. Like Better is a good example of that. I was always a pretty big fan of Better because I liked the technological sort of disruption, but they got crushed. When the market sort of swung, and so they went from a top 20 lender to not even in the top 60. But it's a pretty fascinating. In fact, I can look up right now where they are as of like even year to date. Is it Better Home Mortgage or is it Better Lending? I'll have to look them up to see exactly where they fall. But it's even year to date. We're almost done the first quarter, and you have United Wholesale at 10 billion year to date, Rocket at 8.9, Cross Country's at about 3.6. But then all of a sudden Fairway slipped a few slots. Now it's DHI went up like 5 or so slots to 2.6 billion.
And that's going to continue. That trend of the builder mortgage company, DHI, and Lennar and others like that, they've got a natural built-in advantage right now. If you're in a inventory constrained market, they're the only ones that have inventory and control the growth of inventory. And pretty much, I don't know. That's a question for you guys that I don't know the data point on. What is the traditional capture rate of a builder mortgage company for a builder client? I don't know where that is. It feels like it's 80 or 90%, but I don't know.
Yeah, I always thought it was super high. I mean, all the like real estate mortgage partnerships I've worked on, whether it was at Rocket or today at NewZip, the biggest thing we lost to was in-house, the captive builder financing. It felt like if they get a shot at it, their credits and their rates are just. I mean, I remember when rates were were in October last year, some of the builders like DHI were quoting like 4% interest rates and things like that
Right.
if you bought their inventory. So to some extent, it felt like you couldn't beat it in that market. But I think it varies depending on the market. I think sometimes it matches up pretty closely, but it felt like the past year they're getting every deal they want because it's not even close in terms of the client experience.
Oh, I agree completely.
I'm not all that experienced on the builder side of the business, because in large part because it has been so captive. So, my gut, my instincts, which generally which generally tend to have a fairly tight standard deviation just because of my experience around this stuff, probably would be around 2/3 of that business probably is captured. Generally if you, there's just so many incentives and it's so difficult to really compete apples to oranges without some kind of, I don't know. It's not a level playing field. Let's put it that way.
Well, you've got the reality is you have economics at a builder in two different chains. You've got, revenue that's going to come from the sale of the home and revenue that's going to come from the execution of a mortgage in the secondary market. And it feels like they're using, both of those on one general ledger to say how to keep this customer in house, right? Whether it's discounts and upgrades on countertops and bathrooms or, a $10,000, permanent or temporary buy down to get that interest rate, to Brock's point, down into something that's 200 or 300 basis points below market. And really in that case, the only lenders that can compete with a builder mortgage company that can do that kind of financial maneuvering with discount points and things is somebody that has done a good job with a builder division or a really heavy emphasis on builders with their forward commitment product, right? Where they're all chipping money in, the builder's chipping money in, the lender's chipping money in. And then, gosh, if you're an IMB and you're putting a point or two into a transaction to win the builder over to match what they're going to do to get that rate down to compete with a builder mortgage company, is the loan even so profitable for you, right? So it's a conundrum.
It really should be. It'll be interesting to see what. Did you guys watch the president's State of the Union address last night and some of the incentives that were announced?
Didn't watch it. Just caught the big sound bites. Had some reactions to that.
Yeah, same. I mostly saw the headlines this morning about all the first time home buyer credits and things like that.
I'm just curious around, just even from a policy standpoint, how these actually, from a presidential standpoint, because it's not coming from FHFA. It's not, I don't know, it's not coming from Fannie or Freddie, I don't think, like where do these policy proposals actually emerge? Because it seemed rather interesting. I think to have this now. To me, I'm apolitical. Honestly, I'm almost like a political atheist. I don't have a party. I don't affiliate.
I think it's interesting timing that whenever we're in an election cycle, that anything like this comes out this close to, an election, right? When we're 8 months away. It seems cute to me, honestly. $5,000. Let's just step back from that and think about that in today's dollars and cents terms. Okay. So we've got almost no inventory available. The most impacted potential home buyer is the first-time home buyer, who's already proven over the last 2 years of origination to have very little for down payment, to have income that's still on the rise, very high debt ratios, and we think that $5,000 as a tax credit is going to get them into the game, competing against cash buyers, against Wall Street that's buying these same properties for investment purposes. Like, to me, that's like throwing grass seed into a windy day when you're trying to get your grass to grow and it just sprays everywhere. I don't think it has a concentrated effect.
Yeah. My thought was similar to that in that, I'm definitely more, I'm a DFL kind of Democrat as far as like Minnesota, right?
Yep.
I'm more of a blue dog Dem than I am anything else. I lived in Minnesota for 10 years. That's why I throw that out, your way, but Minnesota always seemed like to have a really good balance, politically between balancing sort of, economic priorities. So it was a magnet for so many years for good innovation. A lot of tech companies were along Lake Minnetonka and Target, Best Buy, and a lot of companies were founded or relocated in Minnesota. But then it tended to but then, and then the flip side was they always had a good commitment to, outdoor, toward guns and hunting and walking paths and bike paths and different things to be able to enjoy the environment, but it struck me that if you wanted real reform, you'd limit if I think it was like 30 or 40% of all purchases last year were done cash by investment banks, right? Completely out of the market. So 30, 40% of the market was completely taken off the slate for lenders to actually lend against those homes to help consumers. They were bought and turned into rental units or turned around. And it just seems like if you wanted meaningful impact to free up inventory right now without having to actually build a single home, just put 30, 40% of those homes back on the market by preventing firm.
Well, and I feel like that was part of the, again, I didn't watch it, but I feel like something early this morning, my dogs got me up about 4:30 this morning, which is about an hour earlier than I would have otherwise hoped for. But so I started, scrolling through the phone, and I feel like I caught something that there was a proposal in his announcement last night that included a bill to essentially, limit or ban Wall Street from, buying these first-time homebuyer type properties. So to your point, that if that's seen through, or if that's just conjecture, but if that was seen through, that could, weaponize your concept, Rick.
So I didn't see the ban. What I saw was that there was a $10,000 tax credit that if you sold it to a consumer versus sold it to an investment bank.
Yep. See, that's the 4:30 in the morning brain right there. How I'm recalling things. Right,
no, that's okay. No, so so it seemed to me, again, it's a distinction without a difference. I don't really think it's going to matter in the marketplace, because oftentimes you receive, as if I'm selling my home, I don't really care who buys the house. I don't think someone's thinking to themselves, oh gosh, I can get a $10,000 tax credit. I think they're thinking, I need to move this house as fast as I possibly can, take the first offer I can get, and here's this all cash offer. I don't ask, like, is it a single mom? Is it a couple? Is it an LLC, an S corp?
That's fair.
Who are these people buying the house?
A lot of states, and maybe even federally now, they banned those love letters, right? Where you explain to them why someone should sell to you versus someone else.
100%.
Well, even if you separate that out, guys, like Rick makes a really good point. And I don't think that, my wife's a realtor. I watch the behavior of the current state right now, what she's dealing with. I think what I've seen as a trend is sellers and listing agents are sitting back and saying, hey, I'm going to list the house on a Friday. I'm going to let it stay open for a week and a half. And then a week later on a Sunday, I'm calling for highest and best. And on Monday morning, I'm going to make a decision. So like a 9-day span with intention. And it creates this feeding frenzy. And to your point, though, where I think you're spot on, I've never seen a situation where they're looking at all these offers and going, single mom, single dad, person of color, person of ethnicity, love letter, no love letter. It's a bottom line discussion, right? It's like, hey, how do I maximize my return on this house? Now, if you said, hey, there's two competing offers that are pretty close to each other, and one comes with a $10,000 tax credit, the other doesn't, maybe that moves the needle, but that's a big maybe. And that's a big, you're asking for a lot there in that decisioning process for a listing agent and a seller of a home to factor through. Yeah. It just doesn't seem practical, to your point.
Well, so we'll see, but I think it's a classic, I think, campaign, slogan in an election year than it is a meaningful reform.
Yeah.
I think that, I think a reduction of rates in loosening, maybe deregulating some of the housing and building requirements, and then looking at zoning requirements from, local, municipal, state, and federal requirements, really looking at that to kind of clear away an opportunity for single, multifamily, and even tiny home and even manufactured home, concepts, I think would really accelerate and expand, home production and manufacturing.
Yeah, I mean, one thing that I don't say nobody, very few people are talking about, and David Stevens, to his credit, started talking about this 5-6 months ago. We're seeing something we've never seen before, and that is the aging in place concept at a level we've never seen it before, with the second largest population in the history of the United States, the baby boomer. They used to move, they used to sell, they used to downsize, they used to move into senior living. And I think one of the biggest consequences that nobody talks about of the great housing recession back from 08 through 13, 14, was the fact that not only did single family residential construction stop because capital wasn't flowing, so did senior living construction. So did 55 plus communities. So did these big apartment looking complexes where you have 3 tiers of solo living, memory care, assisted living, all that stopped for a good 7 to 8 years as well. And that's a huge piece of what contributed to the aging in place concept. And that's really where inventory is, right? What's the statistic? I think I saw there's like 62 million homes that are sitting, still owned and occupied by baby boomers. Now, I'm not saying that there should be 62 million more homes available for inventory, but some percentage of that normally would have moved, right?
Yeah.
Normally would have gone into some form of other housing.
How does it feel to age in place, Michael?
I'm doing it right now.
Well, I always say, people always say, like, Rick, why do you need such a big house? I'm like, dude, you know how many kids I have? I'm like, I got 6 kids. These kids, they're
you
gonna
got
come
me
out,
by one.
and then
Yeah, exactly.
It's gonna be the boomerang effect. They're gonna come back, and then they're gonna go, and then they're gonna come back. So
already experiencing that. That's why I'm gonna age in place. Plus I have 3%, first mortgage, but it's probably more practical. I'm going to age in place because I already have my first boomerang. This left when I got a first job and then came back. It's like,
how old's your youngest?
Youngest is 16, oldest is 25.
Oh, that's right. Yeah. See, my youngest is 12 and the oldest is 26. So it's the same kind of a.
Yeah, it's a lock-in effect plus the boomerang. Yeah.
And do you have, and Michael, do you have 6 kids or 5?
5. No, you've got me by 1. Yeah.
Yeah. Yeah. Now, we've made up for you, Brock. So you got some time. You got 11 kids on the call.
Take your time. Yeah. Take your time.
I have a 1 o'clock. You guys keep talking, and but you guys, I have a 1 o'clock, so I'll keep it going. But you guys keep rolling.
Sounds good. Right. Appreciate it, Rick. Good to see you.
Yeah. So one of the things I wanted to ask you on the broker point we were getting into earlier was, did you see in the past? It seems like now with these 3 dominant players that you were talking about, that there's, and maybe I'm a little, I'm no expert on the broker space, but I've partnered with a lot of them in different ways. It seems like there's pretty similar products across at least Rocket and UWM. It's not like there's dramatic pricing can vary, bits of it can vary, but it's a lot of pretty like vanilla products, isn't it? With across those.
Yeah, I will say this. In the last 12 months or so, both organizations have entered into alternative products, maybe even to the point where I never thought they would before. They even made public statements that wouldn't originate, non-agency loans. Now, they've all originated jumbo loans over their entire timeline, but I'm talking non-QM like bank statement loans and DSCR loans. And I think I remember both organizations saying they've tried to stay away from those products for a multitude of reasons, risk management being one reason. Maybe they don't flow their processes as well, but they do both have some of those products now in their arsenal, and they're originating those. And so you're right. There is not a lot of product differentiation between the two of them, or even between them and PennyMac. Really, where the differentiation is in the ecosystem that they've created for the broker. I mean, that's honestly how they're differentiating themselves. What does it feel like to put the Michael Brenning loan or the Brock Cassidy loan through their process? And both of them especially have done such a great job of creating such an amazing experience for the loan originator and the consumer that you kind of get hooked, right? You're hooked into that. And then you go to another wholesale lender and that process feels quite a bit different, quite a bit less sophisticated, less smooth, less coordinated. And, I get why they have such high, market shares between the two of them.
Yeah, for sure. It looks like there's some pretty good network effects too of, giving them, other, like the associations like AIM and NAM are highly associated with the two, and networking and all that good stuff. But I was, going to a slightly different point that, like, historically, when you think about the broker versus like the IMB loan officer, I'd always thought, my first mortgage job was at Rocket. So, my biases, certainly exist. But I kind of always thought that the idea of the broker was that they're working with 50 different lenders. They can find a solution for any situation. And like for lack of a better way to say it off the top of my head, like they have access to a lot of weird products. They have access to a lot of niche products. Yeah. And that's kind of where I always thought the broker filled in a good gap for especially banks, but also IMBs. Do you still see it that way today? Or Rick made the comment earlier of like a lot of these brokers could almost be UWM employees because they're just kind of just a sales force that's using pretty typical products. And I don't know enough about UWM to say whether that's true or false, but is the idea of being a broker still kind of, or was I off the whole time of them being? No,
I think you were definitely on in the And one thing that's, I've seen firsthand between Fairway and now looking at, other opportunities as I'm kind of working through what's next for me and talking to a lot of IMBs and a lot of wholesale competitors and institutions is, you're right. If you go back over the history of time, the average wholesaler and the average IMB didn't want to have these massive product catalogs because to support it is very difficult, right? Especially if you're going to support it through human power. Now, the fact that Rocket and UWM have done such a good job of technifying and digitizing their origination processes, they can feather in other products now and have them start to feel a lot like a GSE or a government loan. But what I've seen is the IMB world has done a much better job widening out their risk tolerances, weaponizing other products. Specifically coming from Fairway, I was blown away when I joined the firm back in November of 22 to see the product arsenal that they had. I expected all the things that I expected to see, bond programs and all the govy products and conventional products, but they had several hundred, non-QM products and DSCR products and bank statement products and bridge loan products and HELOC products. And I think that's something I've seen in IMB land develop over the last few years, and probably because of necessity, not because of desire. Those loans are harder to manufacture. And if you think about the average IMB in retail land, they generally don't have the tech that Rocket and UWM have. So it's harder for them to put a manufacturing process together for some of these unique products. So there's still a very good argument for the Orions of the world and the Loan Stores of the world and all the non-QM specialty firms that are out there. Shout out to HomeX and a few others that are in the space that do a great job. NQM funding down in Florida. Like, there are companies that specialize in the origination of certain loans where that's the best experience for the broker because they are specialists in that loan type, and they're going to be better than a Rocket or a UWM because they do that loan all day, every day. Even though the technological experience isn't as good, their knowledge of the product and their willingness to get in the weeds and build the loan with the broker is probably a better experience. Gets more.
Yeah, that's kind of how I always imagined it. At my last company at EasyKnock was like a prop tech sale leaseback company, so it's kind of like an alternative to a cash out refi for people with bad credit scores, things like that. Yep. So I partnered with I don't know, we probably had like 10 good lending partners at like at the IMB level, but we had dozens and dozens of brokers that would bring us their deals with some hair on it. Basically, they were cycling through all the different options that they have for a loan, and then we were one of them. And that was kind of a fun thing to be at that time. That was my really first exposure to the broker space, other than a little bit of Rocket Pro TPO when I was at Rocket. So I think I got a little further into that mindset as the broker being the creative fixer for the complicated loan situations and those kind of things. And
I think you're right on with everything you said. And one thing that Rick brought up earlier that I think is worth considering, and he's right, this power of three in other industries, right? Kind of have the big three, and then you have kind of I think he called it a wave of other fish underneath the whales. I'd argue we have a big two, and we have three big lenders, right, in the wholesale space, the three that I've named, but we know of this ultimatum that still exists there, that if you work with Rocket, you can't work with UWM and vice versa. And so really, if you're a broker, you have two choices, not three, on the big side of things, right? So, I think my point in bringing all that up back to the previous conversation and now is I think there's concentration risk with how much of share exists between really two players right now. And if either one of those two were to wobble or go under, which I'm not suggesting either one of them will, albeit history. I mean, if you went back to 1995 and said Taylor Bean and Whitaker was going to go under, people would have laughed you out of the room. They had 65% market share. Same thing with InterFirst when they went through their transitions to Citibank and others and were ultimately, shut down. Same thing with Countrywide when nobody ever expects that to happen given the share and the size that these people have, but then it happens. And then each time I watch the broker community absolutely scramble with their hair on fire to find who's next and what's next. And broker share dropped in every single one of the instances when that happened.
I was listening to a podcast this week about Standard Oil and how they kind of built their monopoly in the late 1800s, early 1900s, and it was kind of the same thing where they had a couple like sworn competitors that they slowly were consuming, and then they didn't have any competitors left. And it's probably good that Rocket and UWM for the market, right? I don't know about for the client, I'm not sure. For the broker, I'm not sure, but it's probably good for the market that they are such sworn enemies because they're probably not doing things like collaborating I think you and I both our experiences at Rocket and looking at UWM can
pretty naturally assume there's no collaboration going on.
Exactly. Which, I mean, that probably makes it marginally healthier that at least the two are not, doing anything to become one. Because I think that would be tremendously risky.
Right.
But yeah, it's definitely interesting to see. And that whole ultimatum and, game on from Rocket, whatever, all that stuff's been super interesting to follow. And to me, it never really felt like the right thing for the broker community, but maybe there is some healthy market dynamics that it created, that there is competition at least.
I've thought about it, ad nauseum, till I'm, blue in the face, and I don't know if I have a position one way or the other. I think choice, again, is the superpower of the broker, and anything that limits the power of the broker to choose openly, I think is bad for the consumer. So, I'll leave it at that, right? I'll leave it at if you limit choice, you limit the broker's superpower, which ultimately has an impact on the share the broker community will have long term. Yeah.
What are you working on right now, or looking at working on throughout kind of the rest of this year?
I'm looking at my sheet and kind of looking down a list of companies that I'm talking to that are, several in wholesale, several in correspondent, some in non-QM, some in retail. The one thing that's always happened over my career is I've taken, positive progressive steps over my career. And this is the first time I've run headlong into a market that is in all ways, shapes, and forms fighting against progression in my career. And so, I'm trying not to rush into anything. And so I've just been exploring opportunities. And what's been cool for the last 30 days of kind of sitting on the sidelines is the number of people I've talked to, not within my own organization, because I don't have an organization now, has been immense. I probably talked to 10 or 15 senior leaders across the range of asset classes and program types and channels. And so I'm getting a really good view of what's going on in the market from all angles, from the IMB retail platforms, from the consumer direct platforms, from a servicer's perspective, from a non-QM securitiser's perspective, from a non-QM wholesale originator's perspective, kind of getting all these different vantage points. And it's kind of a neat perch to have. And it's probably the first time in my career I've really had the opportunity to talk that openly, because I've got no company to heed to or be betrothing to, right? So
yeah, that's interesting. Any categories jumping out that you think are going to do really, whether you're going to associate yourself with that directly or not?
Yeah, no, great point. I think there's two burgeoning things that are in my head. There is a burgeoning marketplace for what I'd call business purpose lending. So think of the role that the community bank and national bank and regional bank has played historically in new construction lending. And generally you could close your eyes and say, an LO is going to ask for a new construction loan, and their company's going to say, what? We don't do new construction loans here at our company because we don't have the capital base to lend on them. That's a bank product, right? I've heard that 27,222 times over my career, right? And it's true. Like IMBs, they're not structured with a capital base that generally can support new construction lending. However, in the last 3 or 4 years, there's been a proliferance of business purpose lending entities that have found capital in Wall Street, whether that's hedge funds, REITs, money management firms, even some PE firms, some VC firms are investing in non-bank construction lending. And so there's companies out there now that can go to an IMB and say, hey, we want to help you develop a ground up construction lending program to win over the builder community. And now I'm not talking about Lennar or DHI, right, or DR Horton, or Pulte. I'm talking about going to the non-publicly traded mid-sized and smaller builder that doesn't have their own mortgage company, but that needs some financing, because all those smaller and mid-sized builders have generally relied entirely on the community bank and the regional bank to fund their ground up developments. And so there's some firms in the space now that are non-banks that I'm seeing could make a really big difference for the IMB and the IMB originator if they can leverage those products. So that seems really cool. And if you think about the demographic of that,
is that what we talked about? Like builder JV? Am I thinking about that the right way?
No, actually not a JV in any way, shape, or form. Okay. This is more of a weaponizing and arming an IMB LO with a ground up construction product where they don't have it today.
Any IMB LO, not specifically the ones that are not
tied to a JV. Correct. Yep. Okay. Exactly. Yeah. Yep. So that's a cool development, and I think that has major legs with all the capital that's being put behind that space, and the trend of, the only way we're going to solve our way, or one of the main ways we're going to solve our way out of this inventory crisis, is to build it. These smaller and regional builders need alternative capital sources. So I think that's a really neat highlight that I'm seeing. And then I think for the first time this time around in non-QM, non-QM kind of became a thing again in 2017, 16 and a half, 17, with Deep Haven and Verus and a few others kind of restarting that marketplace. And then it hit the wall again in 2020 when the great, pandemic hit and Wall Street shut down. I feel like non-QM is definitely something that's here to stay now because of the last 24 months of industry pressure. The average loan officer, the first time in 20 years, has had to embrace the concept and the product and find the customer and learn how to do a bank statement loan or a DSCR loan or a 1099 only loan or all these unique products. And so I think the next time that rates cycle back down, whenever that is, and I'm not here to even, predict that in any way, shape, or form because it keeps changing, but there will be a time that rates do come down, albeit not to the levels that we've ever seen, as low as we saw in 20 and 21. But when they do come back down, normally what happens, Brock, is LOs get distracted, go back to doing, the traditional conventional govy loan, right? That's easier generally to do and faster. I'll argue that the non-QM trend that I'm seeing, a ton of capital and institutional players have entered that space, and I think penetrated loan officers' minds well enough in all channels, IMB, consumer direct, depository, and the broker space, that they're here to stay, right? They're not going to forget about non-QM because they've seen that it's made a difference in their paycheck and in their lives of their clients. So it's another big kind of emerging trend that I'm seeing.
Yeah, that seems like a really positive trend. Yeah, thanks for sharing that.
Yeah, of course.
I don't think Rick's coming back on here. I think we would normally wrap up here. Any final thoughts or questions here?
No, enjoyed being on. I'll continue to participate with you guys as a commentator and a questioner. Follow you guys every Friday, and we'll continue to do that. I appreciate the invite and just flattered to be here with you guys today. So thanks for having me, Brock.
Awesome. Yeah, we'll have you come back on before long. Thanks, man.
All right, sounds good. We'll see you. Enjoy the weekend.
You too.
Yep.